Jim Biggs has been an entrepreneur for the larger part of his life after serving in the military. He is a partner at Jiroma Enterprises, which is an apartment syndication group investing in real estate assets across the country. Jim is a powerhouse of knowledge and experience, having been in the business for more than 22 years, experienced many economic cycles, and closed multiple deals. In this episode, Jim shares his key takeaways from a deal he went into contract in on December 25th, 2019. He walks us through 5 months of him and his team feverishly working to close the deal amidst uncertain and rapidly changing economic conditions. He goes into detail about his mindset on some of the critical variables that changed, including the business plan, property management company, lender, and more. You don't want to miss this one. Mr. Jim Biggs, welcome to the show, sir.
Thank you very much. It's a pleasure to be here.
I'm so glad to have you on here. So let's go ahead and give our listeners a little bit about your background and how you got started in real estate.
Okay, well, I'm 62 years old, and I have been an entrepreneur for most of my life. I've owned several businesses. Started out at a very young age, right out of the military. After being on the road with a national firm as a traveling salesperson, I opened my first business with a very good friend of mine at the time, and have had an interest in real estate since very, very early in my life, but kept having other opportunities present themselves that kind of kept me away from it for a long time. So really came to it rather late in life. But I bought a few single family houses right before the previous recession and lost a lot of money in that recession. Most of my money was in the stock market. And at the time really wasn't thinking about real estate, except for the fact that my net worth kept going down because my real estate value kept going down. Eventually wound up being worth about half of what I had invested in the few properties that I was holding. But I noticed that every time I went to get the mail every month, the rent checks were still there. And so even though I had lost a lot of money on paper, I was still cash flowing. And that wasn't the case with any of the losses I had in the stock market. So that really piqued my interest to start investigating and getting back into real estate. In my late 20s, I had gotten a real estate license. I was living in Florida and started investing a few pieces of, again, single family down there. But then opened up an automobile franchise and left the South Florida and moved to the Midwest. And so the real estate career got put on the back burner again. And so it just kept coming back to me, so to speak. I think for most people, life has a way of happening to them as opposed to us happening to life. Most of us don't have that well thought out plan. So we just kind of, put our blinders on and move ahead and just try to do the best we can. And I'm the millionaire next door. I've just been very frugal throughout most of my life. And just every time I had a hiccup, just keep moving forward. And so got very interested in larger multifamily as a way to scale after the last recession. And so that's what we concentrate on now, primarily on C-class apartment buildings. And we do also look at B, but most of our holdings are in C-class in major metro markets. We own in Illinois and Texas and in Arizona.
Now, if we could talk about the deal that you had mentioned earlier, because it was quite interesting. So yeah, if we can just kind of hone in on that and talk about that and some of the lessons learned from that one. So how did you find the deal? And could you tell us that backstory there? What was so interesting about this property?
Well, we had been looking to expand in Arizona. The Phoenix market in particular, as most people know, has been in rent growth, the leading MSA in the country for several years in a row. and we had started to see rent growth slow down a lot in some of our Texas properties and holdings. And so we were very interested in moving to that Phoenix marketplace. And so we went out there, spent initially about a month out there. I have several friends that live out there, so we kind of worked vacation for a while and started making broker relationships and property manager relationships and all the pieces that you need to start to put your foot in a new marketplace, and found some local partners that we could work with, so that we had partners that were boots on the ground with a footprint there in the local market. And then another partner of mine who is a very analytical person was doing most of the looking at most of the deals and underwriting most of the deals, so that we could kind of sort through a bunch of them. And we looked at a ton of deals. We started making offers, and it took us a while, as you know, especially in a major market. It's really hard to break in to those broker relationships and to be taken seriously. And so we did that, and I think we were best and final for 3-4 deals, and then got to the point where we were second, kind of second position on several more deals, and then finally got one we're under contract where we won the deal, and was a long drawn out process. We actually got it under contract on Christmas Day and of this last year. And so we had it under contract, and the long story short, and I'm sure we can get into more detail, but we just lost that deal this week, and finally had to release escrow and let it go.
So this is from the time you got it under contract until now. It's been less than around 5 months approximately, say, maybe almost.
Yeah.
Mm-hmm.
And we had the deal. We initially were scheduled to close, I think, the first week of March, but we had intended to actually close in mid-February. And we had just started to hear, rumors about this COVID-19 crisis. And so we kind of slowed the pace just a little bit to take another look and make sure that we felt comfortable with everything, particularly the lease audit, and looking at the tenant class that we might be stuck with, as opposed to our original business plan leading into this was to re-tenant the property. And so we had to really shift gears very quickly on the fly. And so we slowed things down a little bit. And then as we started to slow down, of course, the crisis sped up. And we started to find that we had a lot more issues with investors that had already committed, starting to get cold feet and wanting to back out, and the lender wanting to renegotiate terms. And but we still had a seller that was entrenched in his mindset of this is a seller's market, and I'm in control of this process, and you guys have a lot of hard money at stake, so we're not renegotiating anything. And so he really held firm to that position throughout the whole process, and which eventually led to us backing out of the deal. But there's a lot more there in that process, things that happened. We wound up changing lenders. We wound up changing the business plan. We wound up changing property managers. We wound up changing the whole, I mean, literally, there wasn't a piece of the deal that looked the same leaving as it did going in.
So what was, why the big change? Because I mean, it's almost like, based off what you just said, you guys ended up changing the entire team. So like, why the sudden change? Like, what was it? Was it because of the COVID crisis, or?
Yeah, the COVID crisis ultimately cost us the deal. I would have to say that was the impetus, because had it not been for, I think, COVID, we wouldn't have had investors start to get cold feet. Had it not been for COVID, we wouldn't have had the bank start to want to renegotiate the deal. and some of the terms, um, and um, and also the fact that because of the change in all of that, we decided that the deal was um, going to have to change because the business plan was going to have to change. So the numbers were not, the projected numbers could not remain the same if we couldn't execute the exact same business plan. So we were looking to renegotiate a little bit, not a lot. And actually, we weren't even looking to renegotiate on price at all. We were just interested in renegotiating some of the terms with the seller, but he held fast throughout the process and is convinced that this is a short-term event, that it's going to be over with very quickly. And you can't necessarily fault him for that, because in Arizona, as we sit here today, they have completely reopened the state again. The economy is not any better there than it is, say, for instance, in California, New York City, or where I am here in Chicagoland. But they are at least making the initial movements toward trying to reinstate the economy. So if you're a seller in that environment, and if you believe this is short term, that nothing's going to be serious, then that kind of fuels his belief that he's in the right position. Of course, I don't think that's the case at all. As you and I have previously discussed, I think this is we initially thought that May was going to be the telltale of how this is going to hit our industry, but I believe that really we're going to see a steady decline in rent collections is my belief, starting probably in the C-class properties, and it's going to last over a period probably 3 to 6 months, and conceivably even longer. So you really have to make sure that you've got a plan A, B, C, and D.
So you mentioned that the business plan had changed. So could you just tell us what aspects of the business plan had changed? Like, what were you going in? Like, what was the idea going in? And then once this COVID kind of really expanded in the States, like, what part of the business plan did you guys decide to change?
Yeah, I think the biggest aspect of the business plan that changes, we were in a very hot market, and we were buying in an area that had been gentrifying for quite a while. And we bought one of the last remaining kind of the ugly duckling of the neighborhood that had not been rehabbed or re-tenanted, and it actually had a major renovation on the last purchase 3 years ago, where they had done most of the interiors. But for whatever reason, the seller had done that renovation and sold it, and the person he sold it to basically did nothing to the property, and had allowed the tenant base to just get worse and worse with each quarter that he owned the property, to the point that that was the major flaw. That was the major value add opportunity in the deal, was to re-tenant the units. So we had most of the interiors already done. We had some major CapEx issues that are sometimes hard to deal with when you're an existing owner and you don't have proper capitalization. So a sale is the opportune time to come in and make those big CapEx improvements, because you can raise that money and it going in what you need to do. So we had a real big issue with the HVAC system, and that was the major CapEx. And so we had to address that, and we had a plan for addressing that. And as soon as you fix that, then we would start the re-tenant process very aggressively. So basically, if you can imagine being in the middle of a desert and not having air conditioning, the type of tenants that you would be attracting are going to be people who can't afford to be anywhere else and need to be in that area for whatever reason, but can't afford all of the rents because they're escalating very, very quickly. So that's kind of the last property in that area that was like that. So we had the opportunity to come in and fix that and re-tenant. And then COVID-19 comes in, And we realized that not only can we not evict anyone and get rid of bad tenants, but that tenants in this environment and being locked down and shelter in place are not going to be anxious to move or actively out looking for a new place to live. And not to mention, the unemployment was going to start skyrocketing. We've seen that, and now, of course, we already see that we're at like 30% unemployment. So obviously, that business plan had to be ejected, and we had to figure out something else. So we very quickly pivoted to trying to protect the cash flow, and the new business plan was, how can we maintain the cash flow the existing cash flow that we have? If we have to keep the tenant base that we have, how do we get them paying and make sure that everybody there is paying the rent that they are supposed to be paying, and trying to just hang on to cash flow and weather the storm? Because most of these events, if you look back on previous pandemics, they generally are like recessions. They don't last a long time, usually anywhere from 6 months to 2 years. And even the longest case is rarely longer than 2 years. So we just felt that if we could implement that business plan, protect the cash flow, that we could weather the storm. And instead of being a quick 3-year hold, it might potentially turn into a 3 or 5 year. But we still were looking at trying to make it a 3-year hold, but with a very strong possibility that it'd be 5 year.
And so what were some of the ideas that when you were going into this deal, as far as kind of protecting the cash flow and getting the tenants to pay? Like, what were some of the ideas that you guys were floating around for that?
Yeah, well, I think property management is one key aspect to that. And tenant screening is, of course, another big play there. Now, we were in a position where we realized we weren't going to be likely not being afforded the opportunity to bring in a lot of new tenants. But you still, at every time you re-up a lease, you still have that opportunity to come in and reevaluate the tenant that you have in place. And so we wanted to do that because the previous owner didn't share if he actually did that, and it didn't look like he did. But if he did, he wasn't sharing any of that information. So immediately tried to get all that background information from the tenants and start to formulate a business plan around where each individual tenant is in their life, the type of job they have, helping them keep that job, helping them find new jobs, and really engage with the community, and really concentrate very, very heavily on tenant engagement and communication within the property. And then lastly, we were looking for an insurance product to guarantee the rents. And this is something that some friends of mine from Britain had brought to my attention. And then I found out it was also a very popular product in Australia, but was almost unheard of here in the United States. It's in its nascent stages. The only people that seem to be using it right now are in the single family property management realm, especially in the virtual property management realm. And so we were looking to leverage that into larger, a much larger scale with the apartment building, as opposed to a single family.
And what is that insurance product that you mentioned? Is that sold by insurance companies here in the States, or that's like another company outside of the country that is offering that?
There were a few insurance underwriters that were in the space here in the States, but they quickly exited the space. So actively, even the people that had the majority of controlling that particular space in the insurance industry had started halting all of their new policies, and were really taking a hard line, most of them, on payouts. And as you know, with insurance, it's at least for me, it's always been a necessary evil. It's not something that their business plan is not um, on paying out; it's on collections. And of course, you diligently, very diligently, try to pay out only what is absolutely necessary. So, by the very nature of the business, it can be long and drawn out. So. Um, uh, it very quickly became evident that it is a very good idea. I think it was a very unique idea, and one that we had not thought about. When you start thinking about your contingency plans, this was on nobody's radar. And I know, and as you do, um, thousands of syndicators and apartment owners, and nobody is using this product. I have not run into a single person that's using the product. So I felt that we had a very unique play and thinking really outside the box in how to protect the cash flow, and that would allow us to really continue with a very certain business plan that actually allowed us to maintain the offer as far as the purchase price to the seller. But we did need some concessions in some other areas, and that really were not monetary concessions as much as they were terms, and we just couldn't get him to budge.
Mm-hmm.
And so ultimately we walked away. But I still think that's a great business plan. But as of yet, I'm still looking for the right carrier to implement that plan. So if we had closed on the property and move forward today, we have actually, I think, only one possible vendor that would play ball with us in that arena, which you always want to have more than one choice, but still, it's a choice that nobody else seems to have. It's not that they don't have it; they don't realize that it's there, so it's not in their arsenal. So we still felt very, very confident about moving forward with the business plan because of those things.
So you did identify an insurance carrier that would be willing to write the policy. However, it seemed as though that would have been contingent on the renegotiation of some terms with the seller, right, on the seller side.
Yeah, that was the insurance product really was part of our contingency business plan.
Mm-hmm.
What we needed from the seller really wasn't tied or married to the insurance product, although typically these insurance products are only for new leases, and we knew that wasn't going to work. So we were negotiating with renewals, and how do we handle this through renewals? And so we realized that we wouldn't be able to cover 100% of the tenant base, but we don't need to cover 100%. As you know, when you syndicate a deal or underwrite a large multifamily deal, you underwrite for worst case scenarios, and you have a worst case scenario for your occupancy. So you never underwrite for your contingencies, never underwritten for occupancy rates that are above 90%. Typically, you're seeing how far below 90% you can still go and not lose your property. So we felt confident that we could implement that plan, but so many of the lenders were renegotiating, and so many of our potential investors were getting cold feet, that the longer this process took, it seemed the more people were dropping to the wayside, and the more the lenders were trying to either not close or postpone or renegotiate. And it caused us to actually have to switch lenders, which was a major piece of the business plan. That's always, they're loaning you the vast majority of the money to buy these properties, so they're always your biggest partner. And when you have to take your biggest partner and switch horses in midstream, that's a major deal. And so that had to happen. And when it did, we needed some leeway with the seller and never got it. And we asked for leeway in terms and never got it.
Now, will we be able to just kind of go over some of the terms, like where you found that the seller wasn't, because you said you didn't go back to renegotiate price, it was just terms.
Mm-hmm.
So
Yeah.
kind of what was it that the seller didn't want to budge on?
Well, let's go back to the investors for just a second and why we switched lenders. Okay. Um, so the capital raise for us, we had a group of investors that we were used to working with that were used to buying a very typical deal from us. And so I'll start right off by saying that those were mostly investors that had been used to the deals that we were used to seeing in Texas. And these were not heavy value add deals. They were really more yield type deals with strong cash flow. And that's what our investor base was used to looking at. And this deal in Phoenix that we finally won, Phoenix is a very different market than DFW or Houston or Austin, San Antonio. Very, very different. And much harder to find that a deal that looks very similar as far as the yield and the cash flow in the deal. And so we wound up winning a deal that was a real strong, heavy value add from the standpoint, if you think about it, we're going to re-tenant. So you're looking at possibly having a huge dip in tenancy in your first year, and also a very big dollar per door because of the CapEx issues that we had. So it was a very heavy value add. So the deal looked very different to our investors. And so when you put that together with the COVID crisis, and we're already convincing people, look, this is a new kind of deal that you've never invested in before. So you have to convince them, you have to sell them on a new business plan that they're not used to seeing. And so when we had investors start to back out, we were not, it didn't look like we were going to be able to close with all the investor capital coming in on time. So we went back to our lender, our original lender, to extend the closing date. So that we could, try to get our capital raise in place, because we were going to come up a little bit short. And so that was the first stumbling block. And so we got the extension eventually from them, and we then had them renegotiate the terms where they wanted us, and this didn't happen consecutively. It's like, okay, we asked for the extension, got that, and then a week later they come back and cut proceeds, and so now they're asking us to raise even more money. So you're starting to see that you're getting behind the eight ball a little bit. And then the seller, we went to him and to try to negotiate with him to see if he would be willing to do anything, whether it be, we were totally open-minded, to any creative solution, whether it be a seller carryback, or whether it be some kind of seller credit, or renegotiating the price, or have him take care of the capital improvement and then pay him a higher price for the property. So we were open to almost anything, but he wouldn't budge. And so we went back to our lender, and the lender also wouldn't budge. And now, because we had been pretty aggressive, this is a bridge loan product, and we had been pretty aggressive in negotiations with them. And I think that now we're getting pretty strong into the COVID-19, and a lot of lenders are pulling out of deals. So they seen this as an opportunity to renegotiate some of those terms that we had fought pretty hard to get. And we just felt the deal wouldn't work. And so now we're scrambling, trying to decide what to do. And so we start looking for options and alternatives, whether that would be bring in another large capital source, or another large capital partner, or switch lenders. And so we're scrambling now, and the clock is ticking, because on most of these deals, when you're in a major market and try to win them, the clock is very, very short, and you have to be very aggressive to get the deals closed. And so we did find another lender that would allow us to come in closer to the terms that we had originally had, and actually allowed us a little bit more in proceeds. So the capital raise was completely stalled. So we decided to take the deal out of syndication and just take it private amongst several owners, that where we would all just bring all the capital to the deal and kind of put all of our eggs in one basket. As opposed to having 50 investors, we'd have 5. And so we started going down that path, and the deal was still working. But then we're scheduled to close, and the lender asked for an extension. We go back, and the seller gives us an extension. Then they come back and want to renegotiate terms again. And so it just every time we'd come up with a creative solution, every time we'd find and all the while we're changing the business plan. We rewrote. I think we had 15, 20 versions of the business plan over the life of this process of trying to close the deal. And each time, you've got to step back. If you can imagine, it's almost like starting over. Now, of course, there's a lot of the pieces you don't have to go out and walk the property again. You don't have to go out and start doing surveys and all the title work and all that stuff. So it's not completely starting over. But also during this time frame, we realized that the property management we had in place, when we started trying to sat down with them and look at redoing a business plan, after 2 iterations of that, we realized that they could not move anymore, and we lost confidence in their ability to execute the business plan. So then we had to start looking for and re-interviewing people that we had already discounted on property management. We initially had, I think we interviewed 15 property managers in the Valley and narrowed it down to 3. And so we went back to the other 2 that were in the kind of the final run, and eventually renegotiated with one of them and decided we could still move forward. And but then when we had proceeds cut again from the second lender, and we went back to the seller and tried to renegotiate again with various terms, just couldn't get anything done. And so eventually we just decided, look, we can keep hanging on to this deal, and we can keep trying to make it work. But there's a point where, he wants to move on, and we just felt like I didn't see light at the end of the tunnel. I didn't see a path forward.
So if you were to maybe pick out, and I'm probably sure this could be really difficult, and it's probably not just any single variable, but if you were to pick out maybe like the single biggest variable for, this deal not coming to fruition, which would that be?
You're right. That is, I have been racking my brain about what we could have done differently, and and what could have saved the deal, or if there was a fatal flaw in the deal. And there's so many moving parts that happened that any one of them come together, the deal probably would have went forward. But when all of them, when the lender, cost us the deal, the seller cost us the deal, the business plan cost us the deal, the investor capital raise cost us the deal. Because, if you take any one of those, if we could have not had a renegotiation from the lender, then we would have closed. Even if once we had the renegotiation with the lender on either of the 2 lenders, if the seller had been willing to move or budge on any piece, price, terms, a carry back, or any creativity from him would have saved the deal. Or if the investors, if they had not started to get cold feet because of the fear from COVID-19, then we would, in the past, if you needed to raise capital and you had a deal that had good looking returns, and the deal had very good looking returns, now then it would have been very easy to raise a little bit more money. And so that didn't happen either. And then lastly, and I think if I had to pick only one, I would say that it's kind of hard to say um, you know that someone can be naive when they're 62 years old and have owned as many businesses that I've owned, and have been in several large deals like this already, and invested in a lot of doors. But I think I was naive um, in respect to our ability to convince all of our investors to invest outside their comfort zone. Mm-hmm. I thought that if the returns were promising enough, that you could get a yield investor to become a value add investor. And I think that was when you combine that with the COVID-19 and the fact that I didn't have a investor database that was used to investing in that type of asset, it was just horrible timing.
Yeah, it does seem as though like just an entire confluence of events, and that just kind of got upended by the crisis. Mm-hmm. Because I mean, you went into contract. What was it on Christmas Day? I think you said, right?
Yep.
Yeah. And I mean, just immediately after that, it's kind of like, things started going downhill abroad, and then it kind of just trickled right down back home in the States. Yep. And speaking of these things, we can't predict these. We have no idea when they're going to happen.
Exactly.
And I mean, I'm sorry to hear that you lost this deal. I mean, it seems like it would have been an amazing deal. But what would you say to people out there, especially right now in this climate? So, I mean, like, we're already in the midst of this whole COVID-19 crisis. So what would be, like, from your experience with this this particular event, what would you say as some words of advice to other investors out there that are still, hey, I want to get a deal, maybe it's a first deal, or maybe it's existing investors that are going after new deals right now?
Well, right now, moving forward, I'll tell you that the amount of hard money that this is kind of a crisis waiting to happen. I don't mean COVID-19. What I mean is the prevalence of hard money in deals. How much money you have to have hard. And I assume most of the listeners here know what we're talking about. We're not talking about single family hard money lenders. We're talking about hard money, which is your earnest money deposit, which is non-refundable, and has been a common practice in all major markets over the last, 5-10 years. And it was only a matter of time. And I'm one person, but I'm sure there's a lot more out there in the industry that are not coming forward. I know a couple of people that lost all their hard money, and I'm just one story out of that. But typically, I never ask our investors to use any of their initial investment for hard money. I always put that up myself, and so it was a major hit. And right now, I'm still looking for deals. I'm not looking for deals that require me to put hard money in. Mm-hmm. You see a lot of the big players in the industry had moved out of the major markets. And if there's any trend that I've seen over the last 12 to 18 months, it was how many people were moving out of the major markets, moving into secondary. Had started moving into secondary markets even 2 years ago, and over the last 12 months had very strongly started moving into tertiary markets, chasing yield and chasing returns. And as investors, especially as passive investors, but even passive or active, we had become spoiled with how easy it was to make money in real estate over the last decade. And so the real test is going to be who's able to make money moving forward. And so it'll be really interesting to see how many of us survive and how many of us, lose everything. You know, I know that Rod, you know, in his seminars loves to talk about his what he calls his opportunities, you know, AKA business failures in the past, and how he came through those. But even looking at people like him that are, you know, considered leaders in our industry, I look at a lot of people in that arena that were also investing primarily, mostly in tertiary markets. They had pulled out of these major markets because this hardened. I think that either, you know, it's two things. You either don't have the capital required for those big hard money deals in a major market, and so you don't have enough, or you're not willing to risk it. And so I had enough, and I was willing to risk it. And I think that I was reading a book earlier this week where they talked about the spirit of entrepreneurs as risk taking. And so I've always been an entrepreneur, and am not risk averse. And it bit me in the ass pretty hard this time. And so I'll be a little bit slow. You know, I'm looking at deals with a very different eye. And we had talked about the insurance product. That's I'm looking at possibly getting, see if there, because it's a market that's so underserved right now. I will not. That is from here forward as part of my business plan on every new deal that I'll be looking at. Just like the hot thing in the market starting 2 and 3 years ago was bonus depreciation and cost segregation, and that became the new hot thing to do to maximize some of your returns. Well, for me, protecting cash flow against all unseen and unknown things that you can't protect against. The insurance product, your two biggest costs typically are taxes and insurance. And for me, insurance just became a much bigger piece of that, because I will not move forward without that. So it's an underserved piece of the insurance industry. So right now, one of my next plays is I'm looking for people that are interested in partnering up with me to offer that insurance product and possibly bring it to market in a big way.
Mm-hmm. So going forward here with these offers, and I actually want to circle back with the deal that you had in Arizona. How far after you signed the agreement that your EMD was supposed to go hard? Was that like within a few weeks or immediately?
Yeah, pretty. We gave ourselves. We had 15 days of due diligence, 15 business days of due diligence. And then the money went hard. And but we had already done most of our due diligence. Typically, when we go into a deal, we have done a big part of our due diligence before, during the LOI phase of the deal. So before we've even signed a contract, we've started due diligence. And if we feel from our walkthroughs, and we typically will take vendors with us to do our walkthroughs. And so when we make our first offer, we have a pretty good feel for how much we're going to need to spend before we ever get to due diligence. And so due diligence really for us is just to verify what we already believe and to uncover things that we might have missed. You know, so we'll go a lot more intensive. But really, due diligence for us can happen very, very quickly because we're lining everything up ahead of time. So as we had mentioned, how much hard money you're willing to put down is a major piece to winning these deals. Purchase price goes without saying. Purchase price is it's almost a non-starter. Everybody's going to offer top dollar for these deals in these primary markets. So you're not going to win a deal usually on purchase price. And so speed of execution becomes a key component, and how much hard money you have becomes a key component in winning these deals. And so, you know, we tried to go very, very quickly on this deal. We had really intended to close. If things had gone according to plan, we would have closed in probably 45 days. So before March 1st, we had hoped to close.
So I take it that going forward, then, as far as whatever offers you guys put in, you'll still have your money go hard probably after due diligence. But do you think you might include some additional contingencies in there, or?
Absolutely.
Mhm.
Absolutely. Yeah. So in a seller's market, they want no contingencies. Okay. So if you give them what they want, that's how you win a deal. And, you know, throughout my lifetime, um, I've been through several market cycles, and we're all familiar with a lot of contingencies that have been thrown out and have continually been deleted from contracts until you got to the point where the contracts that we've been signing over the last few years were so heavily weighted in favor of the seller that really you had no protection as a buyer and no protection for your hard money. And that's why so many people had been moving to secondary and tertiary markets. It's not just the hard money, but it's the ability to keep some of these contingencies in their contracts. It's the risk reward. They weren't willing to take the risk in the primary markets that were required to win some of these deals. So I'm looking, I will probably, the deals that I look at the next 6 months will have a lot more contingencies in the contracts. And I will be looking to avoid my money going hard without having some protection. I think it's called the force majeure clause of contract that you're probably familiar with. That
Yeah.
Mauricio had been really on social media speaking a lot about that particular clause and how it was important. But I'll tell you for a fact that that clause was not in any of the contracts of the major markets that we were dealing in. And so I don't think I will ever sign a contract if that's what it takes to win a deal in a primary market moving forward. I don't know that I'll ever win another contract in a major market because I will not allow myself to be in that position again. And that's not true for everyone. You've got to look at your risk profile. Um, I am not risk averse, but I'm also 62 years old. And, so I have to look at protecting my nest egg. I have to look at protecting my family. I have to look at protecting my wealth, even though by standards of common people in the population, I'm in the top probably 2%, 3% from a standpoint of net worth, but it's not a lot. I'm getting through this crisis just fine. I'm not worried about my month-to-month expenses or anything like that. But I don't look at my life like that. I look at my life, and if everything stayed like this, where would I be in 5 years? If everything stayed like this, where would I be in 10 years? And how many times can you afford to lose a high six-digit number in your lifetime and recover from it? Well, that depends on your net worth. If you're and your liquidity. If you're losing each time you have a big hiccup, if you're losing 10% of your liquidity, 10% of your net worth, then that's fairly easy to recover from. But if you lose 50%, that's not easy to recover from. And I've lost more than 50% many times in my lifetime. And I say many times, probably half a dozen times. But I've always recovered and always, the old 2 steps back to take 1 step forward. Or 1 step back to take 2 steps forward. I've always come out ahead and have luckily, I'm hopefully not going to lose my battery here. Have always been able to move forward and be in a better position each decade of my life. But I don't know how many more of those I can sustain when you're 62. But if you're in your 20s and your net worth is $100,000 and your liquidity is $20,000, you can't afford to lose. It's hard to even find a deal that you can get into anymore for even as a passive investor for $20,000. So imagine if you invest in deals and lost that entire 20,000, and it took you another year or 2 years, to build it back up. For everybody, they have to look at that risk reward and how long it takes them to recover from that, and how much they're willing to put at stake. So for me, moving forward, it's going to be either look at different markets or have a different. I'm hoping that it becomes a buyer's market again. Is what I'm hoping, and I'm not convinced that it's there. I'm seeing people make claims that we've already seen a 25% correction in pricing, but so far I'm not seeing it. So I'm waiting for proof of that before I move forward. If I see that kind of correction and I see a willingness to accept, some contingencies that are realistic. I mean, let's face it. I don't think you can't make a deal that's. We've been making deals that were so heavily stacked to the seller from the standpoint of risk reward that it was really out of balance. And even in the best of times, when it's a buyer's market, I've never looked to make a deal with anyone that hurt them. I'm just looking for protections against the unknown and unforeseen. And I don't want to be the only loser when you have those kind of things. And in this market, that's what it is. The buyers have been the only losers.
Mm-hmm. So how could our listeners get in touch with you if they wanted to reach out?
I am all over Facebook and LinkedIn. Those are my two primary social platforms. And my contact information is all over both of those platforms. If you know where to look for contact info on LinkedIn or Facebook, my cell phone number is there. That's my personal cell phone. My personal email account is there. Very easy to find.
Well, Jim, I really appreciate you sharing about this experience that you had and, your wealth of knowledge. I truly believe our listeners will get a lot of value from this episode. I really appreciate it.
So, well, thank you very much, Dion. I appreciate you having me on, and I hope that we impart a little bit of hard-learned lessons for everybody that's listening.
Absolutely. I think we did.